A very warm welcome to the RBSA Knowledge Series webinar. Good evening to our friends and clients from India, and a very good morning to our friends and clients from US. On behalf of RBSA family, I thank you all to attend the session. At the outset, apologies, we started off a bit late. There was some technical issue at the back end, so we just resolved that issue. My name is Chetan Khandaria. I lead the due diligence and the transaction service practice at RBSA Advisors. Friends, you would be aware we completed 2 knowledge sessions in the last 2 weeks. First one on the business restructuring and the second one was on due diligence. Our topic of today is on cross-border merger, a mechanism now available in our law to support cross-border transactions. To discuss this, we have with us our partner Ravi Mehta, who share insights on the topic from an India perspective. Ravi heads RBSA transaction tax practice. He has personally been a friend for several years and have been regular speaker on this platform. For those who are attending for the first time, Ravi is a chartered accountant by profession and has more than 2 decades of professional experience where he has advised several clients across sector on M&A and tax restructuring transactions. When we use the word cross-border with any term, it reflects that an event involving more than one country. Hence, to provide a holistic perspective to today's topic, we felt relevant to also invite other experts who can provide the perspective of another country that also allows cross-border merger. When we talk about foreign investment and cross-border business with India, the key country that always crops up first in our mind is United States. We are very delighted to have on board Mr. Paul Helderman, who is a tax partner with Withum, Smith & Brown, and Mr. Raj Tripathi, who is an international tax principal with Withum. Raj is also in charge for the US-India corridor. Withum is an assurance advisory and a tax firm headquartered at New York with offices across US as well as outside US. Withum is also an important independent member of HLB network, which features among the top 20 global advisory and accounting network today. Talking about Paul, he is a licensed CPA in New York and New Jersey. He has been focusing on US federal tax matters for over 30 years now. His specialization includes transaction advisory, due diligence, tax consulting, and he has advised several Fortune 50, 500, and 1000 corporations across sectors on income tax accrual matters, tax department, internal controls, and tax planning. In his stint, he has advised multi-billion-dollar acquisitions and dispositions from income tax perspective. A warm welcome to you, Paul, and a great having you with us. Both Ravi and I personally know Raj Tripathi since almost 5 years, and we share very good rapport with him. Raj holds degrees in law both from Chicago Kent College of Law, US, as well as the Government Law College, University of Mumbai. He has been practicing US international tax law for more than 20 years, now presently based out of Washington, D.C. In his professional tenure, Raj has advised several US MNCs and businesses on the US-India corridor on various international tax matters, both inbound and outbound, including cross-border M&A. A warm welcome to you, Raj, and nice to have you with us.
Thank you.
Thanks for having us.
Thanks for having us.
Yeah, thanks. Coming to today's topic, the past couple of decades have witnessed a phenomenal rise in globalization. One of the key contributing factors of global economic growth has been cross-border transactions. Statistics indicate that almost half of the overall global M&A volume constituted cross-border transactions. Even the first quarter of this year that had been eclipsed by the pandemic, 40% of the M&A transactions were cross-border. We all appreciate that it's an unprecedented difficult time presently, and all businesses are indulged in going back to their drawing board to re-strategize how they can survive and reboot themselves to the growth trajectory. This could entail bringing challenges in their operating modalities, financing modalities, movement of funds between entities, raise fresh funds from foreign markets, and of course, redefining people roles and responsibilities. This would require businesses with an international spread to effectively restructure, that is, restructure in a manner that not only proves its effectiveness, but also helps in cost saving. A cross-border merger is one of the tools available in the India and the US law that could not only help achieve global M&A ambitions, but also facilitate effective restructuring in the current time. Hence, without taking too much of your time, I would like Ravi, Paul, and Raj to share their insights about the cross-border merger from an India and US perspective. All listeners will remain muted throughout the session. You may please post your questions in the box given on the screen. If time permits, we'll have Q&A session. I am sure that like all our sessions, you will find this session also very enriching. So over to you, Ravi. Thank you.
Thank you, Chetan. Very good evening to everyone in India and a very good morning to our friends in US. A warm welcome to Paul and Raj on this platform. As Chetan rightly said, businesses are going through unprecedented times. Many of them are in stop, plan, and refresh mode to achieve a survival strategy that can hopefully get them back into their original growth trajectory. As I have been mentioning in my earlier session, corporate India also are taking various initiatives around this, be it in form of effective liquidity management or fundraise at both local and international level, or merger for reallocation of operations, or say measures for stake and control enhancement. Globalization has been the byword of success since past few decades. While the current pandemic may have put a brief pause on cross-border businesses, with the MNCs also thinking on operational realignment between the countries, cross-border businesses are definitely here to stay. Also, while M&A deals have fallen sideways momentarily, it is expected to regain momentum as economies reboot to the new normal. So with all this realignment and M&A strategies getting a revisit, with cash conservation as the new mantra, we have an effective tool, as Chetan mentioned, available under the Indian law that can come handy while re-strategizing in this current times. So this tool is called cross-border merger. So what we look to cover today is spend the initial few minutes around the Indian legislative aspects of a cross-border merger, deliberate on the key open areas that one needs to be mindful of before resorting to this tool. More to discuss, then select case studies which may have the potential to use this new tool, and leave the floor open on Q&A basis the time availability. Now, US has been one of the key nations investing in India, both strategically as well as financially, since the time India opened up. Naturally, therefore, those businesses functioning on this corridor also would be undergoing such realignment anxiety. Hence, while we discuss this presentation, I will also be bringing in our friends from Withum, US, Paul and Raj at the relevant stage to share their insights from a US perspective. So before we move to discuss the nuances of the new regulations, may broadly touch upon the concept of a cross-border merger. In simplistic terms, it is an integration of two companies located in different countries. Now, this may be either in form of an inbound merger, where a foreign company integrates into an Indian company, or it may be vice versa. In both the cases, the surviving entity typically issues its shares, securities, or cash to the shareholders of the merging company, except for the cross holdings. Now, upon completion of a cross-border merger, the merging company operations, if any, continues as a branch of the merged company. We generally call the entity that is disappearing as the amalgamating or merging company, and the entity that survives as the amalgamated or merged company. The Indian government has issued rules regulations under company law and FEMA governing such inbound and outbound mergers. Having said that, we may highlight that certain quasi-cross-border arrangements do not form part of these new rules. These may be arrangement between two Indian companies where a foreign company discharges the consideration through its shares, or an integration of two Indian companies which entails transfer of an underlying foreign company, or of course vice versa. These types of arrangements were always feasible even before this cross-border regime got notified. So coming to the legislative chronograph, the Indian companies, the Indian law, in fact, is not absolutely new to a cross-border merger. So the earlier corporate law, namely the Companies Act 56, always allowed inbound mergers. However, keeping a forward-looking approach basis the J.J. Irani Committee recommendations, it was for the first time in the Indian legislative history that the Companies Act 13 allowed outbound mergers. To recap, J.J. Irani Committee was the empowered group entasked by the government to suggest corporate law reforms in India, and whose recommendations held the key in the framing of the new company law. Also, the Companies Act 2013 got operationalized in 2014. However, its merger and compromise related provisions, which were contained in Chapter 15, it got enacted only in 2016. So, having said that, the section which specifically focused on cross-border merger, which was Section 234, it got operationalized only in April 17, with MCA, issuing its underlying rules governing cross-border merger. So, as this company law prescribed for a prior RBI approval, RBI too immediately issued draft FEMA regulations on cross-border merger. Now, such regulations post public comments were finally notified by RBI in March 18. So I will now move to discuss some of these in more detail. So this slide provides the legislative framework that presently govern a cross-border merger in India. As I mentioned earlier, two key laws that have been specifically operationalized for this purpose are the company law and the exchange control. The company law effectively required the Indian company, whether as a transferor or as a transferee, to undergo the NCLT process under Section 230 to 232 of the Companies Act. Now, this effectively means filing an application with the National Company Law Tribunal that would then direct for the clearances with various government authorities such as RD, ROC, and OL before granting its final approval. If it is a merger involving a listed company, then there is also stock exchange and SEBI authorities which will get involved. Now, while the company law provisions prescribed a prior RBI approval, as I said earlier, RBI too has issued regulations that provide deemed approval for companies meeting up certain conditions. We'll discuss this in more detail in my subsequent slides. Moving to other things, the provisions also required, the cross-border merger swap to be determined by certified valuers. So in case of outbound, it has to be the foreign valuer who is recognized by the relevant professional body of the other country. And if it is inbound, then it is the Indian registered valuer as per the Companies Act. It is also important to note that the fast track merger mechanism that is available for select domestic company mergers under the company law is not available when it comes to a cross-border merger. So for undertaking a cross-border merger, one has to resort to a detailed NCLT process only. Timeline-wise, a difference between a fast track and a regular merger process could be anywhere between 2 to 4 months. Also, a legal integration of an Indian company with a foreign company is allowed only if such foreign company exists in prescribed notified jurisdictions. So the criterion of qualifying countries is laid down on this slide. But if I were to, take it as practical, in practical parlance, this list is pretty wide. So except for select countries like North Korea and Iran, technically almost all the other countries are covered, with whom India can legally look to integrate. Having said that, for practically pursuing this, it is also relevant that the local laws of the foreign country also, allows a cross-border merger. So it's very important to check this compatibility before we, venture into any of this process. So for this, on this slide, we have listed down some of the top investing companies, investing countries in, who have been investing in India. And the question comes whether, the domestic laws of these companies, whether they allow legal integration if an Indian company wants to, pursue it. And like if you may observe on the slide, except for Mauritius, Cyprus, and US to some extent, none of the other countries presently have enabling law allowing cross-border merger with India. So the laws of European Union countries like, UK, Germany, and Netherlands do allow cross-border merger, but that's only with if it is within the EU framework. But when it comes to, any outside EU country like India, they have their reservations in their law. Likewise, countries like Singapore, UAE, and Japan, they also don't allow any form of cross-border integration at all, whether it's inbound or outbound. And if I were to, come to US, one needs to look at the state-specific laws to determine the permissibility of a cross-border merger. For example, based on my past experience, a cross-border merger could be possible for select companies which are, registered in the state of Delaware. But I would like to, invite my friends from Withum, US, Paul Helderman and Raj Tripathi at this stage, if they can throw some more light around the US perspective. So over to you, Raj.
Thank you, Ravi. I hope you guys can hear me. Good morning, everybody in the US who are attending from the US, and good evening to folks in India. It's a great opportunity to be a part of this collaboration with RBSA to talk about the cross-border mergers and acquisitions. So under the US law, the US law basically regarding mergers and acquisitions, it's very extensive. And it's a complex, whenever you're doing a cross-border mergers and acquisitions, whether it's from outbound perspective or inbound perspective. The federal government under the Internal Revenue Services provides guidance of applying the Internal Revenue Code and the regulations around the code, as well as you have to look at the rev rulings, you have to look at the revenue procedures, which can be used in any structuring a cross-border M&A transaction, whether it's either going to be tax-free, taxable, or partially taxable. But careful attention has to be given whether you want to have an asset or a stock acquisition, because any cross-border transaction, you have to decide whether you're going to do a stock acquisition or an asset acquisition. So let's, when you do a cross-border transaction, a non-taxable corporate reorganization or a corporate organization generally allows the acquiring corporation to take a carryover basis in the assets of the legal entity. Also, in certain instances, a partially taxable transaction allows the acquiring corporation to take a partial step up in the assets acquired rather than a carryover of the basis. A taxable asset purchase or a share purchase provides a basis step up in the assets or shares acquired. This is something that we will discuss in more detail, and Paul, my colleague, will talk about what elections you have to make under the US 338 regulation to determine whether when you're doing an asset acquisition or stock acquisition, how you can make it a tax-free, partially taxable, or fully taxable. Moving forward, whenever you're doing a structuring of any cross-border transaction, specifically from US inbound perspective, and when a foreign corporation is looking at a US acquisition, or the foreign corporation is looking at setting up a US entity or further expansion in the US, you have to be very careful, and attention has to be given to the type of legal entity in which you're going to operate in the US. The decision of deciding the type of the legal entity is very complex. It involves factors unique to each circumstances requiring analysis. The identification of the correct entity type will generally help determine the tax implication. This will set up a tax efficient structure, and the entire transaction could be planned to be a non-taxable, partially taxable, or fully taxable. Therefore, whenever any company is trying to do an inbound acquisition or set up a legal entity or expand in the US as a part of the cross-border M&A, you have to decide what kind of legal entity you're going to set up in the US or acquire in the US. Some of the legal entities that you should consider from US inbound perspective, is your C corporation, which is a tax-paying entity. You have an S corporation, which is a flow-through entity, but there are certain exceptions to the S corporation that you have to keep in mind. There is also partnership available for companies to think about, because partnerships are elected as a flow-through for US tax purposes. You can also look at, LLCs, as Ravi was mentioning that, Delaware is a great state, but most of the foreign companies, when they come to the US, they do consider setting up an LLC, which is your limited liability corporation. And the best part of it, the LLC, is that under the US check the box regulation, you can check the LLC to be treated as a corporation or as a partnership if you have two or more shareholders, or if there's only one shareholder, then you can treat that as a disregarded or flow-through entity. You also have the individuals in the trust that you can take into consideration, when you're setting up your operations. Now, after you decide the type of the legal entity that you're going to be setting up, you also have to think about that what are the benefits that the federal government is providing in the US that you can try to think about when you're moving to the US or you're trying to acquire a company in the US. There are certain benefits that the federal government provides, for example, work opportunity tax credits, enterprise zone employment credit, renewable community wage credit, R&D tax credit. These are some of the incentives that the federal government provides, which you should take into consideration whenever you're doing any kind of inbound acquisition into the US or you're trying to expand. Once the type of the legal entity is decided and you determine that what benefits you can claim from the US federal tax perspective, then you got to think about the states, which is equally important. One, because states, as you all are aware, that the US has 50 states, and every state has its own laws and has its own tax system. The tax system is all standalone by itself, And as a result of, two states can have tax regimes that are different, and income and transactions that are taxable in one state may not be taxable in another state. Therefore, whenever you do a cross-border acquisition into the US, states are equally important for you to determine which state you're going to set up, do the acquisition, and whether there is any tax triggering event in that state as well or not, in addition to the federal tax that gets triggered. You have to be very careful, when you set up the legal entity. And some of the tax regimes at the state tax levels that you need to consider when you're doing an inbound acquisition is your net income-based taxes, your capital taxes, gross receipt taxes, sales and use tax, other franchise and excise taxes that you need to take into consideration. The next point that you should keep in mind when you are also determining the states that you're going to be looking into setting up your legal entity or do an acquisition is what are the incentives and benefits the states are providing. Because states are equally providing benefits and incentives with this kind of an economy. The states are, looking at how to attract foreign companies and how to attract businesses to expand into their state, which will open up jobs. And therefore, there are state tax incentives that the government is providing, which you should take into consideration. And some of them, for discussion purposes, refundable seller tax credit, non-refundable tax credits, job creation tax credits that's available, enterprise zones, your investment renewable energy grants that the states provide. Sales tax exemptions also are something that they do provide. Moving forward, before I hand over to my colleague Paul, the other thing that you have to keep in mind, and which Paul will also put some light, is when you are doing any kind of an inbound acquisition or expansion into the US, how are you going to finance your US operation? Whether it's going to be a debt or an equity. And if it's a debt financing, you have to make sure that your interest, there are some benefits when you're doing a debt financing, and whenever you're doing an equity, there's some kind of a benefits available over there. And I'm going to hand it over to my colleague Paul to shed some more light from US cross-border M&A. What are how you can structure your transaction, that it's going to be taxable, non-taxable, or partially taxable, and some of the debt financing options that you can consider. Over to you, Paul.
Thanks, Raj. Good evening, everybody, for my friends in India, and good morning to my friends in the US. Happy to be here with you today. As Raj indicated, acquisitions could take a couple forms, whether it be an asset acquisition or stock acquisition, and whether that particular transaction is taxable or not is based on the type of consideration that's given for a particular transaction. If the transaction is going to be structured as a taxable acquisition, there's typically cash consideration provided. If the transaction is going to be a non-taxable transaction, it's generally equity is taken by the seller in those type of transactions, and depending on their individual tax position, they might want a rollover transaction where they're not taxed currently. There's various provisions in the U.S. that govern how these types of transactions are treated under the Internal Revenue Code. If, as Ravi indicated earlier, you could have inbound transactions or outbound transactions. Outbound transactions are governed by Section 367 in the U.S. 367 is when it first came out, it was typically referred to as a toll charge. The U.S. taxing authorities don't take kindly for appreciated assets leaving the U.S. Taxing jurisdictions without getting their pound of flesh of tax. So 367 was instituted to treat these type of transactions as taxable. Whether it was structured as a tax-free transaction in the U.S. or not. 367 essentially treats these a transfer of assets to a foreign corporation as not actually being a foreign corporation. So that results in taxability on the outbound transfer to the U.S. Transferor. And that's in 367A. In 367B, that's referred to as an inbound transaction where a foreign transfer, where you have a foreign transferor transferring assets into the U.S. and along with that comes earnings and profits that have not been taxed previously by the U.S. jurisdiction. There's another provision under 367D that refers to a transfer of intangibles, transfers of valuable intellectual property or what have you, where the IRS will require a company to record a deemed royalty payment, which is another way of taxing the outbound transfer. Another section under 367E is where you have a liquidation of a foreign of a U.S. company into a foreign owned entity, and the IRS treats this as a taxable transaction. They don't recognize that liquidation as being tax-free. Everything I just said are subject to various complex exceptions, which would need to be run to ground by your tax advisor.
Hey, Paul, I'm sorry, I'm interjecting over here. Do you want to, the next slide over here, please? The 367 slide that we just discussed, Can you move to the next slide, please? So, and then maybe, so do you want to maybe?
Yeah, I was going to go into section 368.
Okay, so maybe let's, maybe, can you move to the next slide, please? Yeah, go ahead.
Next slide. Yep. Section 368 is a provision in the Internal Revenue Code that governs tax-free reorganization transactions. A reorganization we see is a statutory merger where two companies merge together with one of the companies surviving, and that can be organized as a tax-free reorganization, as long as the consideration is acceptable, a significant amount of enough equity, which is generally 40% of the consideration needs to be equity. In this type of transaction, it's more flexible in achieving tax-free treatment. A B reorganization, not as flexible. This is where the stock of one company is exchanged by the shareholders of stock of another company. And it has to be voting stock, and the acquirer needs to be in control after that acquisition. It's difficult to meet this type of requirement since, again, there can't be any cash consideration. C reorganization, which is a transfer of assets. This transaction is a little bit more flexible since only 80% of the value of the target's assets has to be acquired with voting stock. There can be an element of cash consideration in this type of transaction. The requirement in order to satisfy the rules of a C reorganization is that the target liquidate. That's a specific requirement in the code. D reorganizations are generally done amongst related parties. Companies want to consolidate operations of subsidiaries. They can do this either on a tax-free basis, or you could have a D reorganization where a company wants to restructure, and there's a business that they no longer want to be in, and they want to spin that off. If it meets various requirements of Section 355, it can qualify as a tax-free transaction as well. Next slide. E-reorganization is just a recapitalization. It's just shifting particular categories of equity, whether it be preferred stock or common stock, but that's a very benign type transaction. F-reorg is just a change in the form or the identity or a place of incorporation of a company. We see these F-reorgs are prominent in the acquisition space amongst S corporations, where in that particular instance, let's say a shareholder wants to defer some of its tax liability, or the shareholders want to defer some of their tax liability. They can maintain an interest in their company, and they go through this F reorganization by dropping the old co stock into a new co and electing a flow-through status for the old co, and an acquirer can come along and acquire an interest in the operating business and achieve some level of step up. As Raj alluded to earlier, this is one of the type of transaction in which basis step up can be achieved for a portion of the operating company's business. G reorganizations, don't see too much of these. This is essentially reorganizations in connection with the bankruptcy proceeding. Okay, next slide. Okay, so the section 338. So if a company wants to obtain, or if a buyer wants to obtain a step up in basis for the underlying assets of the operating business, but the target has valuable contracts that could be difficult to transfer if they did a straight asset purchase. Well, these elections allow for the treatment of a stock purchase as an asset purchase. It's deemed to be an asset purchase. And the two types of elections under 338 is a 338G. And this is where a target is a standalone entity and it's acquired by another corporation. A foreign corporation can elect under 338G as well. But this type of election is not really efficient because there's two levels of taxes. The corporation would be taxed on the appreciation in its assets, and the shareholders get taxed again at their level. And in order, there is basis step up achieved, but at the cost of a tax liability that would be incurred by the buyer. 338H10. Well, a 338H10 occurs. It's a joint election to treat the stock purchase as an asset purchase, and the beauty of this election is that the tax consequences fall on the seller. Whether it be a subsidiary in a consolidated group or an S corp entity. Let's say that consolidated group could have net operating losses that could shelter a gain on a transaction, or whether it's an S corporation, there's only one level of tax. So it wouldn't make a difference to an S corp shareholder to sell stock or asset, subject to actually a recharacterization of the gain, whether it be ordinary or capital. It could be ordinary if there's depreciation recapture on particular assets, but in that case, most buyers would compensate the selling shareholder for any negative consequences of agreeing to make this election. And yeah, as we see here, the 338 election is the only method now in order to be able to get a basis step up. In past legislative history, there were particular fact patterns that resulted in an asset basis step up, where if a company acquires the stock of a company and immediately liquidated it, However, after 1986, with the repeal of general utilities case, which taxes corporations at the entity level, this is no longer an option. So the only way you get a basis step up here is in a stock purchase is by 338 election. Okay, next slide. This is another very favorable election. It's referred to as a 336E election. And this is an election where if there's a qualified stock disposition, let's say you have an S corporation that sells its stock, but the acquirer is of the nature where they don't qualify to make a 338 H10 election. So because it's not a corporate buyer, it could be a partnership that's acquiring them, which we typically see in the private equity world, where a partnership comes in and acquires the stock of a company. The target company can make an election under 336E to treat that as a deemed asset sale. And the consequences of that are very similar to a 338H10 transaction, where the tax consequence lands on the selling entity. So this is a very favorable transaction. It's typically negotiated in your stock purchase agreements. And that's what I have, Raj.
Thank you, Paul. That was really helpful. I think one thing I would like to also highlight, just going on the 338 H10 election and the 336, where you can have a stock purchase can be elected to be an asset purchase, I think what I would also add to this is whenever you're doing a cross-border acquisition, you have to first really determine whether you want to do an asset acquisition or a stock acquisition, because those two acquisition that you focus on will have its own different consequences. For example, whenever you do a direct, you do an asset acquisition, you can do it by using a holding company, but the issues around the asset acquisition is that whether the trade of the business that you're acquiring, how that will get impacted on the US tax regulation, and whether any permanent establishment will get triggered at that point. Also, attribution of profits has to be determined, how you're going to attribute the profits, and then allocation of your interest expense, and your capital has also, these are some of the issues that you have to look into. And then withholding tax on deemed interest expense, your goodwill amortization, your relief from the double taxation, especially, for foreign tax credit, or your participation exemption benefit, credit. So that's where you will have to determine whenever you do any inbound acquisition, whether you want to do an asset acquisition, you want to do a stock acquisition. In addition to that, also the business purposes. What are your business issues, that you want to? What are your expansions plan in the US, And while the expansion plan you are deciding, you also have to take into consideration what I alluded earlier, that what is the legal entity type that you want to come into the US to set it up, and then what is the tax benefit at the federal level, state level, what incentives you're going to be is going to be available. All those things have to be taken into consideration whenever you do any cross-border transaction from inbound perspective. So I think these are some of the highlighted things that we can highlight. We can go and do a separate event specifically focused on when you're doing an inbound acquisition, what are the different tax issues and tax compliances, liabilities that gets triggered, and how you can mitigate and reduce some of those, tax compliances and issues, and we can probably discuss that in a separate event, That said, I'm going to hand it over to Ravi to continue the further discussion. Over to you, Ravi.
Thank you very much, Raj. Many thanks, Paul and Raj, for this eye-opening insights of the US law. Given the US framework that you shared, it's pretty clear that one must be very mindful for and should take up an in-depth examination of the local regime for undertaking any cross-border initiatives with US. So I'll just come back to my presentation. So quickly on the Indian side, on this slide, we are basically given some brief about the regulatory regime for cross-border merger as was notified by RBI in March 2018. So the regulations, which RBI notified, they have been fairly progressive, and they allowed a deemed approval under the automatic route in case where a merger is in compliance with the existing FDI and ODI regulations. This means that the Indian company does not need any prior RBI approval for pursuing a cross-border merger if it is, complying with the FDI ODI regulations, both for its past as well as while doing the merger. Having said that, if there are any previous non-compliances either under ODI or FDI, then the Indian company must get them regularized before it even initiates the process. Under the regulations, as I said earlier, the foreign company becomes a foreign branch of the Indian company in case of an inbound merger. And if it's outbound, then the Indian company becomes the Indian branch of the foreign company. Also, if the regulations prohibit the merged company from acquiring or holding an asset which belonged to a merging company and was transferred consequent to the merger, then such merged company will be bound to sell such asset within 2 years from the sanction of the merger scheme. So if the law prohibits you, you can't hold it. However, you have a window of 2 years within which you need to, offload it. Same is the case with respect to any foreign currency loan which has moved from the merging company. So any such loans will, which is acquired by the merged Indian company will have to be made compliant with the Indian ECB regulations within, the 2 years window. We'll elaborate some of, the key open areas, in the subsequent slides. So first I will pick up FEMA. So the first question is pretty fundamental one, and that is whether like a merger, does the cross-border framework also allows a demerger? Now, the earlier law, that is Companies Act 56, they did allow an inbound demerger. Even when RBI came up with their draft FEMA regulations, when company law provisions got operationalized, it did envisage a demerger. However, if we see the final regulations as well as the company law provisions, it nowhere talks about a demerger. So the answer is, I think, pretty settled now that the current framework do not permit a cross-border demerger. Having said that, even a recent application which was mooted by a leading pharma company for a cross-border demerger was rejected by NCLT, citing the absence of framework under the current law. The next area of concern is the write-off of overseas investments consequent to a cross-border merger. Now, any inbound merger entails a foreign company getting merged into an Indian company. So if the Indian company also holds any securities in such foreign company, then such investments get cancelled under the process. Now, as per ODI regulations, generally, an unlisted Indian company can write off its overseas investments only up to USD 10 million under automatic route. So the question is, would a prior RBI approval be required if, say, cancellation of investments under a cross-border merger is about 10 million? And as there is no specific clarification around this, the answer is possibly yes. You need a prior approval if the write-off limits are breached. The third point relates to holding of immobile assets. Now, both the FDI and ODI regulations allow a branch office to hold an immobile asset if it is required, for its business purposes. Now, take a case where an Indian company has invested its surplus cash in an immobile asset for investment purposes only, and such company is now looking to get merged with a foreign company. Now, after this Indian company gets merged, it would become a branch of the foreign company, and in that case, the immobile asset, will need to be sold off within a 2-year window. This applies only if this asset is not needed for business purposes by the branch. If the branch needs it to use it for its office or for any other business purposes, then it can continue to hold it. The fourth point, I think, relates to the inbound merger where the Indian company ends up being a foreign branch post the merger completion. Now, the prevailing FEMA regulations prescribe limits within which any Indian company can make remittances to its foreign branches, and this is for meeting its recurring expenses. Now, this limit is basically 10% of Indian companies' average annual sales or turnover during the last financial year. Now, this could actually pose a practical challenge post-merger for the foreign branch, if it is not self-sustaining, because, its finances for meeting their local operations will now be curtailed to only receiving funding up to 10% of the average annual turnover of Indian companies. Coming to next point, this again relates to an inbound merger scenario. So one of the conditions of ODI regulations is that if the Indian company transfer the shares, then it has to bring the sale proceeds back to India within a 90-day period from such transfer. Now take a situation where 100% foreign subsidiary is merging into an Indian parent, and this is leading to cancellation of its shares. Now, as such, a cancellation is also transfer, except that the Indian company here is not going to receive any sale proceeds from the transfer. Now, as the regulations aren't clear on this aspect, one may wonder whether one has to go to RBI to seek a specific clearance. If you ask me, my personal view is logically you shouldn't, but it would have been really good if the regulator could have specifically clarified this under the law. There could be also situations in which inbound merger, there would be situations in case of inbound mergers where the merging foreign company may have a step down subs, or step down subsidiaries or joint ventures. Now, the Indian merged company in such a case would need to comply with the 400% net worth limits under the ODI regulations for holding such step down investments post the merger. Now, at times, this could really become a challenge, especially when the merging foreign subsidiary has acquired such step down investments by leveraging overseas debt. Now, if the 400% net worth ceiling is breached, then definitely a prior RBI approval will be necessary, before you pursue such inbound mergers. This condition, however, is not applicable if there is a third-party inbound merger. Next is the case of an outbound merger. So when an Indian company merges into a foreign company, and if such Indian company has Indian shareholders, then such Indian shareholders end up acquiring shares in the merged foreign company. However, for acquiring such foreign securities, the ODI limits will apply. So under the ODI regulations, you have a 400% of the net worth limit in case of corporate shareholders, and up to $250,000 per financial year in case of resident individuals. Now, given that, honestly, if such mergers actually do not entail any foreign exchange outflow from India, and hence, one really wonders that whether imposing such condition under the regulation is really worthwhile, and it definitely it would merit a rethink by the regulators whether they can remove that limits. The next point is relevant in case of an outbound merger, where post the merger the Indian company becomes an Indian branch. Now, if the Indian company has manufacturing operations which needs to be continued, then it won't be able to carry such operations from the Indian branch. That's because normally FEMA regulations prohibit a branch from carrying any manufacturing activity, unless such manufacturing operations is located in a special economic zone. So it could really become a challenge as to what to do with this manufacturing operations once post merger the Indian company becomes an Indian branch. The last point is basically the condition relating to compliance with the ECB regulations. Now, in case of inbound mergers, if the merged Indian company inherits overseas debt liability pursuant to the merger, then such debt would need to be it needs to be compliant with the ECB regulations. Now, this has to happen within 2 years of the merger, and the compliance has to be with respect to conditions relating to all-in cost ceilings and maturity period as laid down in the ECB guidelines. Now, if these conditions are not complied with, then cross-border merger regs require such debt to be either repaid within 2 years, and that too, you cannot repatriate anything out of India for making such repayment. It has to be only out of the overseas funds, and this could at times become a practical challenge. If overseas operations are not generating enough cash flow for either repaying or servicing such debt. One respite is that the existing ECB regulations also contain end-use conditions for availing any foreign loan. Now, fortunately, such end-use conditions do not apply when a debt is passed on through a cross-border merger. I would say that is a welcome respite when this regulations got introduced. So bottom line, from a FEMA perspective is that while you have rules and regulations which are pretty progressive, there are definitely certain conditionalities that require very careful examination before you resort to a cross-border merger. I'll now going to come to the next discussion area, which is around tax. Now, apart from company law and FEMA, the most significant and complex aspect of a cross-border merger is the income tax. And while you already heard about the US side, I will also bring something about the Indian side when it is specifically with the perspective of a cross-border merger. So there are several tax aspects that merit examination before the choice of a cross-border merger is made. And the fundamental of all is the bona fide purpose and commercial rationale for any proposed cross-border merger. Now, with the GAR provisions having its place in Indian law, this examination is absolutely sacrosanct. Likewise, if the critical mass or people of the merged business is expected to reside in India post the merger, then the ramifications under the place of effective management rules, what we call the POEM rules, also merits examination. The next aspect is the taxation framework, which which is applicable to a merger transaction, and this could be at two levels: the company level and the shareholders level. Now, the relevant tax areas would be capital gains, deemed dividends, gifting provisions, and transfer pricing. The current provisions of income tax law are pretty clear with respect to inbound, and it offers absolute tax neutrality in all those areas when a foreign company looks to merge into an Indian company. However, the same is not the case when it comes to outbound, as there are no specific exemption provisions under the law around outbound mergers, and when Indian company merges with a foreign company. Hence, a thorough case-to-case examination would be very critical if one were to pursue an outbound merger. The next aspect would be the applicable tax rates on the operations of merging company once the merger is completed. So technically, post the merger, the merging company would become a branch of the surviving company, and its operations would reside in such branch. Now, if it was a case of an outbound merger, the Indian company would become an Indian branch, and in such a case, the applicable tax rate on such Indian branch would be 43%. Now, before the merger, when it was a company, the same operations were getting subjected to 25, 29, or 34% tax rate, and it now suddenly jumps to 43%. So, such increased tax rate should also be it can also have an immediate cash flow impact on the merged company, and this needs to be duly factored to avoid any undue interest meter. The other tax aspects whose consequential impact would be important are possibly MAT credits, tax holiday benefits, and unabsorbed losses. So take an example, say a foreign merging company has unabsorbed losses, and its local provisions allowed carry forward as well as carry back of losses for a specified period. The question is whether such losses will be sustainable even post merger for the foreign branch. While one part is the eligibility of foreign branch to claim under the foreign law, the other is, can the merged Indian company also factor them while determining the Indian tax liability on such foreign branch profits? If one were to look at the provisions of 72A and 72 of the income tax law, they aren't so enabling to allow this. Due to this, there could still be a tax outflow at a group level due to additional Indian exposure. Similar would be the case for transfer of MAT credits as well as impact of a running tax holiday benefit. And one thorough examination of Indian and foreign law, including the treaty provisions, would be essential before any inter-country benefits are pursued. One more critical aspect of a merger, and this was also discussed when we were talking about the US side, is basically the tax treatment of goodwill. So say there is an outbound merger where the foreign merged company has recorded goodwill in its books. Now, as this goodwill relates to the merging Indian business, can the Indian branch post-merger also claim tax depreciation on such goodwill, relying on the Supreme Court decision in Smith Securities? While this aspect is not free from doubt, the accounting treatment of such goodwill in branch books would also hold the key to this examination. Lastly, for a non-tax neutral merger, it would be equally important to examine the transfer pricing provisions, both at a company level as well as the shareholder level. Alignment of TP policies between the merged entity and the merging entity based on arm's length standard would definitely become sacrosanct. Now, there can be several other operational aspects, such as determination of branches asset base, or say allowability of interest cost, or say determination of branches tax computation in the year of merger, etc., etc., which may merit a thorough analysis when one pursues this initiative. So, in nutshell, if I were to just conclude this slide, as has been rightly pointed out in the even in the JJ Irani committee report, which mooted this cross-border merger, suitable changes are also necessary in the tax law to facilitate cross-border merger, especially in case of outbound. On this slide, I would want to discuss the other regulatory laws. So, while enabling operational provisions have been introduced in company law and FEMA for the cross-border mergers, similar enablers are they are equally critical in other legislations such as securities law, stamp law, accounting, competition law, and GST. So on securities law, while the SEBI takeover code specifically exempts any acquisition of Indian company shares which gets acquired pursuant to a merger, and this is from the requirement of an open offer. Having said that, the existing provisions of other securities law like SEBI SCRA or SEBI ICDR, they don't have much flexibility with respect to outbound mergers. Hence, executing an outbound merger of Indian listcos could have its own challenges. The key challenge being how to discharge the consideration to the merging company shareholders. So while IDRs, what we call the Indian depository receipts, could be an option for the foreign merged company, but such instrument hasn't been popular with investors due to its inherent regulatory limitations. The other challenges could be non-flexibility of current regulations to allow a direct listing of a foreign company on the normal floors of Indian stock exchange. So this is something which is presently not yet been made feasible. Although an alternative, which is an international exchange at Gift City in India, is something which can be explored. But having said that, one may wonder whether the same would be acceptable to the Indian shareholders and the regulators, because Gift City is yet to get its operating mass. Likewise, I think the other aspect could be the dual stamp duty ramification on the merger order. This especially can happen if the foreign country also levies capital duties on a merger transaction. So as there is no inter-country set of provisions currently existing under the Indian stamp law, there could be a dual duty exposure for the merged entity. Apart from this, there could also be practical challenges in mutation of immobile properties in favor of foreign companies. And this especially happens if properties are, not, they are merely held as investments and they are not used, required to be used for business purposes. In such a case, disposing of such properties before the merger would be possibly the need of the hour. From competition law perspective, there could be regulators' approval involved if the transaction reaches the prescribed thresholds. This may also apply both in India as well as abroad, basis their respective laws. And accounting-wise, the merged entity may also have obligations to prepare separate branch accounts under the local GAAP for local compliance purposes. This would be over and above its obligations to record the merger in compliance with the local GAAP. So apart from all of these, it would be also critical to examine the ramifications under the GST law with respect to the continuity of credit. So in nutshell, as has been rightly pointed out in JJ Irani report, effective operationalization of cross-border merger would require some pioneering work between various countries in which such merger are being executed. So with that, we will conclude our technical discussion and now move to discuss few indicative structures. Before we commence this discussion, I may flag that these are merely indicative thoughts, presuming certain situations. Also, each of these indicative structures have been put up with an underlying assumption that there exists sufficient commercial consideration and bona fide rationale to justify the structure under GAR, and there is also no poem situation. And it is also assumed that the foreign country jurisdiction has enabling cross-border provisions. Lastly, as I said, these structures are merely indicative thoughts, and there could be also other alternatives as well, which can be ideated to achieve the same objectives, which are laid down on the case in the case study. So we'll come to the first case study, which deals with externalization of Indian operations to facilitate any overseas fundraising opportunities. So the extreme left side, if we see on the slide, it reveals the current structure that has an Indian company, ICO, which could be an early stage company or a company with negative net worth, but definitely better growth prospects. So the founders or promoters therefore wish to externalize these operations, the underlying intent being to pursue two objectives. A is to tap better fundraising avenues abroad, and B is to pursue overseas expansion. So how could they achieve this? Now a potential option could be, say as step one, the existing shareholders set up an Indian holdco with token capital and contribute their existing shares to such holdco. As ICO is in losses, such contribution should have marginal ramification under the gifting provisions of Section 56, for the holdco. Now, if ICO again, if it has any material tax losses to be preserved, then an alternative to such subsidiarization could also be ICO demerging its existing operations into the step-down wholly owned subsidiary. Now, as a step two, a friendly non-resident investor may be tasked to set up a foreign company, which is FCO, with some token equity, and this FCO can be either a holding company or a operating company. And finally, in step three, the Indian holdco merges into FCO through an outbound merger process. And because of this, FCO will now issue its shares to the holdco shareholders. And therefore, what we now get is a structure that serves a purpose. That is, all Indian assets are duly externalized. In terms of key ramifications, if FCO is a pure holdco, then a conservative view could be that this acquisition through the merger process by Indian shareholders may entail an RBI approval. But basis our experience, such approval shouldn't be difficult to obtain, and there exist past precedents also where RBI has granted such approval. And if FCO is an operational company, then a view may be possible that no such approval should be required at all. Secondly, as outbound merger is presently not tax neutral, the authorities may also look to tax the share swap under capital gains provision. Having said that, the tax impact out here may not be significant if the current value of India business is not material in view of its losses and negative net worth. So the end result is the current shareholders get to externalize and tap the global markets when their current valuations are absolutely reasonable. Moving to the next case study, this deals with the situation of a closure. So the current structure, which is on the left side, it envisages a situation of a foreign company, FCO, having a wholly owned Indian subsidiary, ICO. Now, ICO presently has negative net worth with very small operations, and ICO has no outstanding liabilities, and its assets primarily constitute, bank deposits, investments in liquid funds, and possibly, certain income tax refunds of past 2-3 years. Now, FCO is looking to, wind up ICO and move all its existing operations and cash overseas. However, for inherent reasons, it is not comfortable pursuing the voluntary wind-up procedures under RBSA, because one way to do this to wrap up ICO could be do its voluntary liquidation. Now, therefore, what could be an alternative option now available to FCO to move its operation? And the answer here is very simple, that you can do an outbound merger of ICO into FCO. Now, in view of negative net worth in ICO, there should not be any deemed dividend impact for FCO under Section 222. Also, given the negative net worth and discontinuation of operations, the fair value of ICO shares could be much lower than the acquisition price paid by the shareholders. And hence, there should not be any capital gains impact as well, on this merger. The net result is that FCO immediately gets access to the current cash and operations of ICO upon completion of merger. Typically, normally this kind of merger process should take not more than around 4 to 6 months. Whereas if one were to, pursue a voluntary liquidation process, it could even be, much longer. And what happens in, a cross-border merger process, your Indian company basically becomes an Indian branch where you can also receive the pending tax refunds going forward. And once, these refunds are received and repatriated, you can always close the branch adhering to the RBI's branch office regulation. The key USP of this structure is that the control of ICO always remains with FCO throughout the process. And which possibly is not the case if had you pursued a voluntary liquidation route, and this is something where the objective of FCO also gets accomplished. And coming to this last case study, which is basically for facilitating global restructuring. So this case study envisages a case of effective shifting of IP. So under the current structure on the left side, we have a foreign company FCO that has recently acquired an Indian company ICO, and this they have done at a sizable premium. Now, material part of this premium payment could also relate to an valuable IP which is residing in ICO, and which is which has been the USP of the transaction. This typically also happens in major of the IT sector related deals. And ICO presently do not have any, in this particular case, my assumption is that ICO do not have any material reserves, but it holds this valuable IP. Now, FCO, when they made the acquisition, they believed that IP can be better exploited and protected if, it is parked overseas. So if FCO intends to, continue the ICO operations, in India, and which is, basically its intent, it has also identified select operations which which gets better synergized if they were shifted overseas. So how can FCO achieve both these objectives? One is move the IP, and other is also certain part of operations which can be moved overseas for better synergies. So a potential option could be that, say, as step one, ICO sets up a new Indian wholly owned subsidiary with token equity. In step two, say ICO were to transfer its India-specific operations to this wholly owned subsidiary, and this could be through a mechanism of slump exchange, so that any kind of cash flow can be possibly averted. And finally, ICO gets merged into FCO through an outbound merger. So when you achieve this, basically, so when you finish this, you basically achieve both your objectives. Your select IP and operations both basically now reside in FCO. Now this transaction should not have any material tax impact for FCO, as ICO does not have any material reserves. Also, the current tax basis of ICO in the hands of FCO due to the recent transaction would be very helpful in mitigating any capital gains exposure under the outbound merger. So net, you have all what you needed, you get achieved by this structure. So with that, I basically come to an end of my presentation. Some closing remarks before I pass it back to Chetan. So there could be many more situations where the new cross-border merger tool can become handy for achieving the business objectives. However, as may be clear from today's discussion, a range of complex issues must be navigated to successfully complete such cross-border merger. Each cross-border merger is different, and its effective implementation would greatly depend on several dynamics, which could be underlying facts, scale, geographic scope of both the companies, etc. So we at RBSA Advisors have a dedicated transaction tax team which possess the expertise to support you with such structuring initiatives on a holistic basis. And we also have our US friends also who are part of this webinar, who would be more than happy to collaborate with us, on your agenda as suitable. Before I hand it back to Chetan, I will just take this opportunity to also thank my other colleagues who are, Siddharth, Deer, Bharat, Somaya, and Keyur Bagatia, who helped me putting up this presentation. So over to you, Chetan. Thank you very much, for this opportunity.
Well, thank you, gentlemen, for an exhaustive session. And a topic like this, you brought all the concepts in a very simplistic way. I believe we are running short of time, but we can possibly pick up some questions. I have a question for each one of you. So first, I'll start with Paul. What are some of the critical tax issues foreign investors or a company need to focus on when targeting businesses operating in the US?
Sure, Chetan. The key issue there is going to be the legal form of the target business. That's going to drive the tax consequences typically, whether it be a partnership, an S corp, or a C corp, or a subsidiary in a consolidated group, or even a parent that a foreign company would like to acquire an entire group. If it's a partnership, the company, you typically would achieve a step up in basis, and as we talked about earlier, you get your goodwill amortization generally. If it's an S corp, it could be a basis step up transaction as well. It's a C corp, you could have if the C corp has attributes such as net operating losses, they could be used to offset a 330AG gain if necessary, or if it's available. And if it's a subsidiary in a consolidated group, it could also do a 338H10 transaction. And I mentioned attributes. It's key to understand what the attributes are of a target, whether it has significant NOLs. Under the recent CARES Act, as a result of the COVID, they're able to carry back NOLs 5 years. So it's critical to understand, what those attributes are and negotiate whether it's going to, be for the benefit of a seller or the buyer in any type of acquisition transaction. If the target business in the U.S. itself has foreign subsidiaries, you want to understand whether there's transfer pricing issues, whether they are appropriately documenting their transfer pricing, which I've seen in quite a few tax due diligence exercises. That there's not much documentation in the middle market. That's for sure. Also, when the Tax Cuts and Jobs Act came out in 2017, there was the issue about deemed repatriation. You want to understand whether the company, accounted for that appropriately in their tax returns. You would also want to understand whether, what their dealings with the taxing authorities are, whether they've been under audit or whatever. And, and on the state local side, I've seen many a deal blow up if there's indirect taxes that the company hasn't been accounting for appropriately. Like there's sales tax in all 50 jurisdictions in the U.S. So that is key. So that's some of the the critical issues that you really need to focus on.
Yeah, thank you, Paul. So a related question to that. Also, it might not be directly related to today's session, but something around the current crisis. So what is the current stimulus package the US government has proposed to address COVID-19 situation?
Thank you, Chetan. I think that's a very valid question. A lot of foreign companies and US companies are looking at, because of this COVID-19 pandemic, with the challenges the companies are facing on the cash flow and liquidity, how are they going to run their operations, especially the small businesses? How are they going to survive? And therefore, the U.S. government had come up with 2 stimulus packages, under the CARES Act, as Paul had alluded earlier, that in any transaction, you have to look at what are the CARES Act benefits that the government is providing. So the few topics, so we'll have to do a separate 1 or 2 hour session on that. But just to give you a little highlight on what the CARES Act talks about, is there's the biggest thing that the CARES Act came out is that they came out with the PPP loan, which is the SBA 7A loan, where there's a forgivable loans to small businesses to pay their employees during the COVID-19 crisis. and the loans have to be obtained before June 30th, 2020. And the first round of application was commented by on April 3rd, and the second round was application was commented on April 27th. And the application has to be made by the private lenders that are approached by the SBA, the small, SBA for under 7A, SBA 7A loan. And the loan terms will be identical for all applicants. So at the end of the day, whether you are going to be a small business with 1 employee or 500 employees, once you apply through your bank or financial institution, the loan terms are going to be applicable to all of the businesses in the same manner. The other benefit that the government came out with the employee payroll tax deferral, which is basically employers. So it's called the employers payroll tax deferral, where the employers and the self-employed individuals can defer payment of their employer's share of 6.2% of the Social Security. That can be deferred, and the amount must be repaid in the equal installment by December 31st, 2021 and December 31st, 2022. So this is another benefit that the government is providing for the employers, that they can defer the 6.2% of the Social Security. The third one that also was kind of highlighted by Paul was the net operating losses. So the Act allows for NOLs arising in the tax years 2018, 19, and 20 to be carried back 5 years. And that's a very good benefit that the companies can look into, that you can go back 5 years. Currently, the corporate income tax rate in the US is 21%. But if you go back 5 years, you are availing the tax annual credit of 35%, which was the corporate income tax rate at that point. So this is a very important act that the government has come out with, and companies should be thinking of availing this, In addition to that, the company has also come out with the 461 excess business loss rules. They've modified that, where the provision modifies various aspects of the excess business loss limitation applicable to pass-through business and sole proprietors. So they can utilize losses sooner. And this specifically, it is a repeal of the, the Limitation Act that was in 2018, and this is from 2018 to 2020. So this is a very important, benefit that has come out with. The next one is a refund for AMT credits. So since the repeal of the corporate AMT, carryover AMT credits currently are refundable over several years, with the balance fully refundable in 2021. So this provision basically accelerates the recovery and time, enabling the C corporation to obtain a refund of 50% in 2018 and a balance in 2019. So this is something that the company should think about, and not going into a lot of these other exceptions, but I would also highlight that the government has come out with a temporary modification of the 163J interest deduction limitation. Under the CARES Act, they have increased the 30% deduction to 50%. So this is a very important provision that companies should think about, that how can they take the interest deduction limitation and increase it from 30% to 50%. They've also come up with a technical amendment regarding qualified improvement property, temporary, and they've also exclusion from income of employers payments of student loans. That is another benefit they've come out with. Increased income limitation on charitable contributions, above the line charitable deductions that the companies can avail. They've also come up with special rules for retirement accounts. So these are some of the highlights of the benefits. There are some more that we can talk about, but I think in essence of time, I would say that Ravi, I would highly recommend that we do a separate session purely focused on the COVID-19 and its impact not only on the businesses in the US, but also on the cross-border transaction. What companies can think about?
Absolutely, Raj. I think really quite interesting, and we should definitely, pursue that. Yeah.
Sure. Over to you.
Thank you. Thank you.
Thanks. So thank you. I think the US government has come up with many measures, and you are right. It would take a session to go into detail. While we have many questions, I'll just try to end with one question with Ravi. Have you seen a cross-border merger getting undertaken post its introduction in the Indian law?
Thank you, Chetan. I would say yes. 3 examples which I can immediately recall. One is the case of Tata Chemicals. Second is Reliance Industries, and third is Godrej Consumer Products. Now, all 3 of them, they had undertaken inbound mergers of their foreign subsidiaries for internal realignment of operations. while Tata Chemicals, involved a merger of a Mauritian subsidiary, Reliance Industries and Godrej, they entailed a US subsidiary. And Godrej also, in fact, they had actually two companies. One was, I think, US, and other was the Mauritian subsidiary. So yes, there do exist, examples around this. But I think what is still missing is, the outbound mergers. And this possibly is due to, certain complexities which, we discussed, in the session as well. Yeah.
Okay.
Over to you, Chetan.
So, thank you, gentlemen, for your time today. And special thanks to Withum for joining us today. We look forward to more collaborative opportunities going forward. We thank to all our listeners for your participation, and our apologies due to paucity of time. We're not able to pick up all the questions, but we have your questions in the box and we'll respond to them over email. We trust you found the session useful and encouraging. We will be having more knowledge sharing webinar sessions for which we'll be sending the details. So please do attend them. Once again, a very big thank you to all from the RBSA family, and stay safe, stay peaceful, and God bless us all. Thank you.
Thank you very much.
Everybody.
Thanks,
Thanks,
Jen.
everybody.
All right, thank you.
Be safe
Right.
and healthy.
Thank you.
Bye-bye.
Take care, everybody.
See you.